Imagine standing on the sidelines while a currency pair rips 150 pips in a single session. If you're like most intermediate traders, panic sets in. You finally jump in to chase the move, only to get stopped out the exact moment the market reverses. The problem is that you are reacting to price movement that has already happened, instead of anticipating the volatility before it arrives. When markets move sideways into quiet, boring consolidation, the retail crowd walks away. But that silence is exactly when professional traders sit down and pay close attention. Look at this animation. Think of a consolidating market like the physics of price compression. The tighter a market is squeezed between two horizontal levels, the more potential energy it stores up. To catch explosive moves, you must learn to hunt the volatility squeeze, positioning yourself inside the setup as the market takes a deep breath, preparing for the spring to release. Notice the upper and lower Bollinger Bands pinch together, signaling extremely low volatility. As this width hits a multi-month low on the bottom indicator, compression peaks. Inside this squeeze, look for an NR7, a single candlestick with the tightest 7-period range. The market is dead silent. That extreme silence isn't random. It represents a tense standoff between buyers and sellers, an equilibrium waiting for a news catalyst to tip the scales. Identifying these heavily coiled zones highlight high probability areas for an impending explosion, giving you a clear region to monitor for the ignition signal. But be careful. The very first movement out of a squeeze is frequently a liquidity hunt. Market makers will intentionally drive the price past the boundary just to trigger retail stop losses before reversing. To filter traps, look for a Maru Bozu candle, a long-bodied candlestick with no wicks closing outside the compression zone. But price can lie, so verify with volume. Notice a massive volume bar below the breakout, dwarfing previous levels. This is the institutional footprint. You have to ensure this is initiation volume, fuel entering at the start of a move. If you see a volume spike after a long drawn-out trend, that is exhaustion volume, signaling the move is ending. A breakout is only valid when that aggressive price structure is mathematically backed by a massive surge in institutional participation. Once that candle closes, you face a tactical dilemma. Do you jump into the market immediately, or do you wait for a pullback? The aggressive entry dictates buying the exact second the breakout candle closes. You use this approach when there is a clear high-impact news catalyst, like an interest rate decision, where the market is unlikely to look back. This diagram illustrates the alternative, the conservative throwback. Here, you wait for the price to dip back down and touch the original breakout ceiling. This entry optimizes your risk-to-reward ratio. The heavy cost of this patience is the runaway move. Roughly 40% of the strongest institutional breakouts never retest the line, meaning you will miss the trade entirely. Your execution style shouldn't be based on personal comfort. It has to be strictly dictated by the immediate momentum and the specific catalysts driving the market at that exact moment. Placing a generic, tight stop-loss just a few pips below the breakout line guarantees market makers will hunt and destroy your position. Instead, use structural defense. As you can see here, you anchor your stop-loss precisely below the lowest point of the ignition candle itself. The logic is straightforward. If the market has institutional power to shatter a major resistance level, it should not possess the weakness to fall back below its own ignition source. For wider setups, you implement mathematical defense. By using an average true range, or ATR multiplier, you guarantee your stop is placed well outside the bounds of normal daily market noise. A properly placed stop-loss establishes the mathematical boundary where the explosive thesis is definitively proven wrong. You survived the entry and caught the move. Now you have to avoid the tragedy of exiting far too early. Capture the vertical height of the initial compression zone and project it directly on top of the breakout point for your primary target. Once hit, transition to a trailing stop. It ratchets upward behind each new swing low, riding an extended multi-day trend. Your ultimate exit signal is a blow-off top, a phase characterized by abnormally massive candlesticks paired with a huge exhaustion volume spike. Breakout mastery requires a conscious shift in your mindset. You stop reacting to market noise, and you start anticipating the silence. Are you ready to hunt the next move? Download our Volatility Squeeze checklist and use the FXNX scanner to find coiling markets. Then, open an NX1 account to execute those setups with 0.0 pip spread.